Hi, I'm Patrick Masters, owner of Parabolic Trading, and welcome to this training. Over the next 20 plus lessons, you will learn the ins and outs of trading stocks. Whether you are a swing or a day trader, you can make a decent living that will allow you to quit your day job, supplement your income, take that extra vacation, or pay for your child's college. I know this because that's what I've done. During my trading career, I lost a lot of money learning how to trade stocks, but I knew what all great men knew, and that's they didn't know everything. So I hooked up with my mentor, learned how to trade stocks, and took what worked and found solutions for what didn't work. After studying day and night, trying new things, I was able to narrow down the best trading patterns and develop a risk management strategy that can help make any trader a profitable one. As you work through these lessons, I urge you to take your time and really absorb what I'm trying to teach you. Watch and re-watch them. I only have one rule for you to follow. You only get one chance to learn something for the first time. For this reason, I beg you, do not trade with real money. While you are working through this course, it makes no sense to lose your capital before you fully understand the rules to each pattern I'm about to show you. If you blow up your account before you master the patterns, it will do you no good because you'll have no capital to trade with. Now let's get started. Disclaimer: trading involves substantial risk. Never risk more than you can afford to lose. Parabolic Trading and myself cannot guarantee you that anything in these presentations will ensure profitability. Substantial efforts have been made to provide quality and accurate information. However, you, the user, assumes all responsibility of using such information. Parabolic Trading assumes no liability for any inaccuracies in this presentation, which may result in you, the user, sustaining any form of financial loss. All content should be considered for educational purposes. No trades or stocks shown should be considered a recommendation, and you, the user, understands that past performance is not an indication of future performance. You also assume any and all liability for any financial transaction made as a result of the educational materials provided from this presentation. Let's get started. There are two phases to develop your trading. First, you must develop your strategy. Most traders never get through this phase. There's a 90% or more failure rate for traders. After you do that, you need to trade your developed strategy. So what is stock trading? Stock trading is the buying and selling of a particular company's stock. You get your trade ideas from a scanner, a call out in the chat room, or from another source. You're going to input your company's ticker symbol into your trading platform software. You're going to use rules of your pattern to purchase or sell a stock at a specific price. Completing a buy or a sell of a particular stock is called a transaction. This is stock trading in a nutshell. The stock market can be thought as one big auction house where buyers and sellers, they attempt to get the best price for their transaction. When you're buying it, you want it at the lowest price you can get it for. When you're selling it, you want it for the highest price you can get for it. Sellers need buyers and buyers need sellers. Without each other, the stock price would never move. So now let's talk about the process of becoming a trader. The first thing you need to do in order to become a trader is you need to learn the terminology. You need to learn the core concepts. You need to learn trading strategies. And you also need to learn the best tools to trade with. You need to learn how to build a trading plan. And then you need to learn how to apply your trading plan with a trading simulator. And then you need to review your trades. Then, and only then, can you start trading with real money? Okay, so let's shift our attention now to the essential tools you're going to need to trade with. First, you're going to need a laptop or a desktop computer. Again, you're going to find that most software offered by brokers are offered natively through Windows. And then, of course, you're going to find there are some that offer in a limited amount that has support on Mac OS. You're also going to need a high-speed internet connection. You don't want to use any dial-up or DSL. I don't even know if they make those anymore or if they offer those services. But you really would like to have a hardwired preferred. But you can trade on Wi-Fi. You just need to be mindful of drop connections. You also need tested and profitable trading patterns. You're also going to need charting software. You're going to find that most brokers, their software isn't great. It's not. They lack a lot of features. You're probably going to end up having to pay for some more advanced software if you want advanced scanning features. Like take, for instance, Thinkorswim, which can be very powerful scanning wise, but you have to know all this code and context and syntax in order to put in to get what you're looking for. Where things like TC2000, sometimes it's just a point and click. Also, you're going to need a broker account from which you're going to trade from. Some additional tools that you can trade with, they're not required. Multiple monitor setups, they allow you for watching more stocks. So if you have additional screens, you can watch an extra maybe 4 to 6, maybe even 8, depending on how small you have your windows. Scanning software, there are paid options out there such as Trade Ideas, TC2000. They are a monthly subscription, but they also give you things in real time, and you get a little bit more extra configurability. You get a little bit more tweaking. You can customize your scanning to look exactly for the types of trading setups that you're looking for. You also want to have a backups power protection in case you lose power. Nothing sucks worse than being in the middle of a trade and losing power, right? Whether it be power to your internet, power to your computer. If you got a trade that's running and all of a sudden it starts nosediving, but you have no power to get into your software in order to cancel your trade or close your trade out, you could have a substantial loss. So having a backup power system, it's not required, but it also helps protect you, helps cover you. You also want to have a cell phone with a hotspot connection for the very reason I just explained. Having a cell phone with a hotspot connection, most brokers have a mobile version of their software, so at least you can log into your software and close out that trade if you happen to lose power. Also, a stand-up desk. It's not good to sit all the time, right? They say that sitting is the new smoking. Well, if you have a stand-up desk, you're forcing yourself to stand up. It's great for your health, and I've also found that it makes me more alert to what's going on. If I'm sitting in a chair watching a trade happen, I'm in a more relaxed state, right? So I'm not in a reactionary state. When I'm standing up, I'm more alert. I'm paying attention. Again, it helps me focus on what I'm trying to do, which is to have a profitable trade. Like I said, all of these are not needed to trade with, but they help give you an edge to your trading. All right, so let's talk about what we're going to look for in a broker. First, we want our brokers to give us fast executions. The direct access brokers, they provide you the fastest executions. We also are looking for standalone software applications. Most web and browser software are not designed for high frequency trading, which is also known as HFT. We want direct access routing. This means you get to choose how your order is delivered to the exchanges, right? Rather than have a company who, let's say, for instance, Thinkorswim, when they send your order to the exchange, they're going to pick the best route that's profitable for them, right? Because again, when it gets sent to the exchanges, it's auctioned off. So they're going to sell that order flow to the highest bidder. So Thinkorswim isn't going to do what's best for your trade. They're going to do what's best for their commission. So again, hotkeys and programmable buttons, then listen, it's easier to hit a key combination to send an order fast, right? Rather than click a button or click a text box, put in an amount, put in your price, select what kind of order it's going to be, whether it's going to be a market order or a limit order, and then select the quantity and then hit a button. By the time you're doing that, you've already missed your entry point. The second you decide to take that trade, again, you need to have your order filled immediately. And the longer it takes you to fumble around putting in your price, your quantity, and hit the button, your stock's already running without you. We're also looking for discounted commissions. You're going to need this if you're a day trader and you complete 5 or more trades in a day. Some of these things, like Thinkorswim, they offer free trade commissions, so it doesn't cost you anything. But they make their money through selling of the order flow. So we want to find a broker that's going to charge us, but we want to find one that's going to charge us what's best for us. So let's talk about fast executions. Some brokers, they offer free trades and commissions. Because they're free, you're going to suffer some execution or some fill order issues. These companies, they auction your order and they sell the order flow to the highest bidder. Your fills may be late getting filled or not at all. Time is critically important. We need our orders to fill instantly. The slightest slippage could wreck your trade. So let's take a look at an example of what happens when you have slippage. So you purchase 1,000 shares, you get them instantly at $10. That trade costs you a total of $10,000. However, let's say that you go through Thinkorswim and then they try to sell your order to the highest bidder. Well, maybe you don't get filled until $10.20. So for the same 1,000 shares that you purchased, it gets delayed and it gets filled at $10.20. Now the cost of your trade is $10,200. So your trade already starts down $200 from your attempted entry. So again, we don't want to, actually you'll understand this when we get into risk management, why it's important, because what we're risking on a trade, that $200 could be what we actually risked on that trade. And as soon as we get filled, bam, we get stopped out and now we're out $200. So now let's turn our attention to platform software. As I pointed out earlier, desktop-based software is preferred because they're more feature-rich and they're stable than web-based trading software offered by nearly all brokers. Have you ever clicked a website and it took a second to load? Do you really want to trust your trade getting executed with this? Mobile software is even worse, even less features than web versions. But listen, here's the thing. You can swing trade on a mobile device, but it's impossible to day trade with. So let's turn our attention now to low commissions. In 2019, firms like Ameritrade, E-Trade, and other brokers, they were forced to respond to Robinhood and the free trades that they were offering. Many before that, they were charging $6.95 or more per trade. That meant when you bought stocks, you had to pay $6.95 to get into that trade. And then when you wanted to sell those stocks, you had to pay another $6.95 commission on top of it. So in essence, it was costing you $14 or more for every trade that you bought and sold. But these companies, they were losing business, so they had no choice but to offer the same $0 trade commissions. But you need to be mindful because it comes at a cost of selling your order flow. Like I referenced earlier, order flow. So when you, let's say for instance, when you take a trade at Thinkorswim and you hit the send button, you have no control how your order gets from your software to the exchange. So Thinkorswim will go out there and they'll say, I have this order that needs to be filled. And all these different routes, they will bid on your order. So Thinkorswim is going to sell it to the highest bidder. Now, here's the catch, is that just because the highest bidder gets it and they're willing to pay for it, doesn't even mean that it's going to get to the exchange any quicker. Sometimes, most of the time, often, it gets there slower. So now let's talk about the low commissions. If we want fast execution, 3, 2, 1. So if we want fast executions, we need to decide what types of commissions we are willing to pay. So we can either pay on a per share basis, right? So let's say, for example, we pay at a per share of, 5/1000ths of a cent, right? So it's 50 cents for 100 shares, or you could pay $50 for 10,000 shares, right? Or we can decide, hey, we just want to do it on a per trade basis. So on a per trade basis, at example, let's say some brokers charge $4 per trade, flat rate, right? So whether you buy 100 shares or 10,000 shares, it only costs you $4. So if you're buying a large number of shares, right? If you're buying, let's say if you're buying penny stocks or what we consider low cap stocks, right? Small cap, right? Which are like anywhere from $1 to $10. If you're buying large numbers of those, you don't want to be paying on a per share basis, right? The only time I want to pay on a per share basis is I'm buying 100 shares, 200 shares, maybe 500 shares. 10,000 shares, I do not want to be paying on a per share basis. I would rather be stuck in a per trade basis. So you have to understand what types of stocks you want to trade. If you're trading things that are higher priced and you're not taking as large positions, you want to be on a per share basis. However, if you are buying large numbers of stocks, you want to be on a per trade. Now, the one thing I've seen with my experience with brokers is they will allow you to select your per share or per trade. Right, so this is the places that we're paying for, and this is not like Thinkorswim or E-Trade or even Fidelity or what is it, Charles Schwab. I don't know, but again, that's the thing, is that we are deciding what we want to pay. So let's say, for instance, let's say you went through Interactive Brokers. They'll give you the option to pick on a per share or a per trade basis. So if you don't know what kind of trader you are or what kind of stocks you want to be trading, you don't want to pick per share if you're going to be buying 10,000 shares of something. So you can change it, but they'll only let you change it like once, I think every 6 months. I'm not sure if it's changed. Again, I have different brokers set up for different things. So if I need to buy large numbers of shares of something, I'll typically either use Thinkorswim or TD Ameritrade. I actually have different software that lets me use it. I'm not a real big fan of Thinkorswim. Some people love it. I'm not a big fan of it. But I have a front end that works over it as well. So that works for me. But again, for other trades that are much lower, right, that I'm buying lower, I want them to be through Interactive Brokers. If I'm only buying 100, 200, 300 shares of something, again, let's take, for example, Tesla. If I'm buying Tesla at $200 a share, I'm not buying 10,000 shares of Tesla, okay? So I want to be able to pay the small rate per the shares. But if I'm going to be buying, let's say for instance, I'm going to buy 10,000 shares of ACB, which is a marijuana company. If I want to buy 10,000 shares of that, I don't want to be paying on a per share basis. I'd rather be able to take that trade for $4 and be able to purchase what I want there for a much lower cost. So let's talk about cash accounts and margin accounts. So with a cash account, you can only trade with the available cash in your account. So let's say, as an example, you have $5,000 in your account and you take 3 trades with that money. You're going to have to wait 3 trading days for that trade to settle before you can trade using those exact same funds again. Now, with margin accounts, they allow you to borrow the money from your broker so you can keep trading instead of waiting 3 days for your trades to clear. With margins, your trades settle immediately and you can start trading again with those same funds. So also, brokers, they're also going to offer you leverage to margin accounts, usually anywhere from 2 to 4 times. I've seen as much as 6 times. So again, a $25,000 account results in $100,000 buying power. So let's talk about the pattern day trade rule, which is PDT. Pattern day trade, right? Traders in the United States, they need to maintain $25,000 minimum in their account balance in order to day trade more than 3 times in a 5-day rolling period. So what this means is, if you want to take more than 3 day trades, so let's say you take 2 day trades today, you take 2 day trades tomorrow. Well, on that 4th trade, if you don't have $25,000 minimum in your account, you're going to get flagged as a pattern day trader, which means if you violate it, your broker is going to suspend your account for 90 days and you will not be able to open new positions. Typically, most brokers, they'll give you a chance. Like sometimes you get stuck in a trade and you want to get out, or you accidentally get into a second one, or thinking that somehow you're going to make some money, or sometimes you don't follow the rules and you go against what I teach you, and you're like, this trade is too good to miss. I know I've already got 3 for the week, but man, it's Thursday, I'm going to jump in this. So what this means in a 5-day rolling period, that means if you take 3 trades on Monday, you will not be able to take another day trade without getting flagged until the following Monday. Now, here's the caveat, is if there is any sort of day in that week that the market is closed, whether it be a holiday or let's say, for instance, let's say it's Martin Luther King Day, or it's Christmas Eve or Christmas Day, that doesn't count in the 5 days. It's 5 trading days. So if Christmas falls on a Tuesday, you take a trade on a Monday, well, your 5 days isn't going to be available until the following Tuesday, because that Tuesday does not count. So you just got to be very mindful. So for people that are going to be day traders, like seriously, you're going to need to have at least a minimum $25,000 in your account in order to day trade reliably. So many of you will probably be swing traders starting out until you build up your account to meet that $25,000 minimum account balance. But remember, even with $25,000, if you take a trade and you lose $100, now you're at $24,900. You're below that threshold, and that will still flag you even with $24,900. So just be very mindful about what you have in your account. So if you're going to day trade, make sure that you're disciplined and that you only take 3 trades, potentially day trades, for that week. Don't take them all on the same day, right? If you take a trade and you lose, don't try to get back in there and do another trade like, I'm going to make my money back. It doesn't work, right? And all you're doing is taking away the available day trades that you have in that 5-day rolling period. So let's turn our attention now to leverage and buying power. This is very important. If your broker provides you leverage, you need to be aware that comes with it increased risk. You can leverage with a margin account as long as it's not an account used for your IRA, which is for your individual retirement. With leverage, you're borrowing money from the broker so you can continue to take trades. This is beneficial when you want to buy a large position in a stock than you can currently afford with cash on hand. Also, it's very risky if you don't know what you're doing. Many newer traders, they foolishly use all of the buying power they can get on a trade. Without proper risk management, which many of them don't have, they can blow up their entire account, or they can end up owing even more money to the broker. So it's not just losing the money you have, it's owing money that you don't have. So most brokers are going to give you greater margin during the regular market hours, but they may only give you 2 to 1 for holding positions overnight. So for example, let's say that you get a 4 to 1 margin on $25,000. So you have $100,000 you can trade during the day with, right? During regular market hours. Once 4 o'clock hits, right, that's end of market day, right? So there's a good chance that you can get a margin call from your broker, which means they will go in there without your consent, they will close any position you have, whether you're winning or losing on that trade, and then they're going to assess you a nice hefty fee on top of it. So typically, you need to be aware of what that time frame is for most brokers. They have a specific time frame. Let's say, for instance, if the market closes at 4 o'clock, they may require you to be under buying power by 3:30 or 3 p.m. So you're going to need to check with your broker to see what their requirement is. But again, you need to be aware of this time, of this limit, so that you can close any of your positions needed to be under that margin, and then you can close the trades that you don't need to hold overnight. Holding overnight is very risky, and you'll learn about this later on. Why sometimes we will, and sometimes I will advise you not to, because you can't control what happens overnight. Right, so while you're sleeping, the market opens up. Pre-market opens up 4 o'clock on some exchanges here, and next thing you know, the stock is tanking while you're sleeping. Right, so again, you want to make sure that you are under that limit before the end of the market day, so you don't get assessed a fee, have your positions closed, and all of a sudden, let's say you're down $300, but you think there's a good shot it's going to come back the next day. Not the way I would manage my risk, but that's what you did. You held it overnight. Next thing you know, you wake up next morning and the thing gaps down $3-4. Now you've taken a $200-300 loss, and now you're at $600, right? Or if the broker closes your position because you didn't get under the 2-to-1 leverage, then you're going to be out whatever you're down. Plus, you're going to get most likely a 50, 60. I think sometimes I've seen them as high as $100. Fee, because the broker has to go in there and manually close your account. So they assess you a fee for that. Brokers, they're going to take every fee they can get out of you. So listen, you've been warned. So let's talk about opening up a trading account. To open a trading account with your broker, you usually need 2 forms of identification and proof of where you live. You must also sign various form agreements and let the broker know your level of trading experience with trading. If you have no trading experience, they may deny you a margin account. This is okay. If you are brand new, margin is the last thing you need to be using. After your broker approves your account, the broker will provide you multiple ways to fund your account. Some brokers, they'll accept an ACH transfer, and those deposits may take some time to post fully to your account. Nearly all brokers, they accept wire transfers, and they'll post in 24 hours. Most of them, they'll accept check deposits, but it could take weeks for them to clear and post to your account. So let's talk about the data feed. When you sign up at a new broker, you have to sign various forms. One form is the data feeds agreement form that allows you to receive real-time data on stock prices, along with things like level 2 and time and sales of a stock's particular trades. When you fill out the form, brokers will ask you a series of questions about your trading experience. All will ask you if you're a professional trader. This means, are you a licensed stockbroker with the SEC or a financial advisor? This is a no. If you were one of these, chances are you would not have taken this course. You are what is considered a retail trader. So let's turn our attention now to paper trading versus live trading. After you open your account and you fund it, you might be itching to get trading. Stop. You should never, and I mean never, take a trade until you have proven that you can be successful using specific trading patterns. As you learn patterns throughout this course, you can apply these patterns using a paper trading or a trading simulator. So when we talk about paper trading and simulator, most software platforms offer some variation of this. This allows you to take trades using fake money. You can place orders much the same way you can on a live trading account. The greatest advantage of paper trading is the only thing you lose on a bad trade is a blow to your ego. So now let's talk about live trading. This is the real deal. This is live fire. If you mess up, you don't know, or haven't mastered your trading pattern, you can, and I promise you, you will lose your hard-earned capital. There is no takebacks. There are no resets, and you still get that blow to your ego on top of it. So let's talk about the first trade that you take on your simulator. When you first open any simulator, it can be an overwhelming experience. Most of you will be tempted to pull out your favorite stock ticker and you're going to fire off a trade. Wrong. Different software has different functions and features. The first thing you need to do is familiarize yourself with how to create charts. Next, you're going to need to figure out how to add indicators to give your charts more meaning. Things like moving averages, price, volume, stochastic, Bollinger Bands, VWAP, etc. Once that is completed, you need to familiarize yourself with your platform's order entry process. All platforms are different. None of them are exactly the same. You also need to become familiar with how to conduct scans and create watch lists in your platform. Most importantly, you're going to have to practice this every day. You need to build the mind muscle memory connection. The more repetitions and the more paper trades you take, the more efficient you're going to become when you start trading live with real money. So we need to talk about order types. The first type we're going to talk about is market order. When you place a market order to buy or sell, you're telling the broker to just give you the shares of a stock and price does not matter. You just want the shares. This can be dangerous. First, depending on the amount of shares you're requesting, the average cost for your trade could be much higher than when you click the buy button. Say you wanted to buy 2,000 shares. You would get a partial fill of 1,400 shares, but you would pay each price shown and the remaining amount even higher. If you had 6,000 shares to sell, you would sell 5,300 at 76.50, another 200 for 49 cents less, and another 100 more for 75 cents less, and the remaining amount for even less, which would shrink your profits. This could affect how profitable your trade is. Pay attention to the price spread. So the second order type we're going to talk about is limit order. Unlike market orders, when you select a limit order, you have to put in an actual price. This limit price is the most you are willing to pay or the least amount you're willing to sell your position for. This is the type of orders many day traders use. You have more control in how and when you enter or exit a trade. However, you do not get to control if your limit price gets filled. When a stock has a wild price spread, this is the type of order I almost routinely use to enter a trade, and also the type of order if I have a defined target that I want to meet. The third order type we're going to talk about is an absolutely important order. It's the stop order. This, oh my lord, I wish I would have learned about the stop order when I first started trading. That's why I ended up losing trade after trade, and I lost a lot of money. Like I would be down $200-300 in a trade, and then all of a sudden it would go to 500, and then negative 600. And of course I kept thinking, oh, it's going to come back. It's got to come back. It can't go down forever. Wrong. So again, I didn't know how to use a stop order. Once I learned this, it changed my trading forever. This type of order will be your greatest friend. This type of order will save you a ton of pain. A stop loss order is triggered when the price of a stock crosses a certain price, right, that you set. You're going to set your own stop loss. When this occurs, your broker is going to send your order to the exchange. This is routinely referred to as a stop or a stop loss. This can be sent as a stop market or a stop limit. The difference is that if the stop market, if it gets crossed, it's going to just fill it at any market price. The stop limit is, let's say that I buy a stock at $10. I set my stop loss at $9.50. If the stock gets down to $9.50, the broker is going to automatically fill my trade at $9.50, and I would lose 50 cents per share. If set as a stop market, if the price reaches your price, a market order is sent and you sell your shares at market price, which means you get no control at that time. Whatever the price is, that's what it's going to be sold as. So if I have $10 and the stock is down to $9, it's going to get sold at $9, whether I like it or not. If I set a stop limit, I'm telling the broker, this is the limit I'm willing to sell my position at. So if I set it at $9.50, it will hit, when it hits $9.50, it will sell it at $9.50. When it reaches this price, an order is sent to the market to sell at this specific price. So let's talk about the three different types of stop orders. First, the stop order market. When your stop price is crossed, it will trigger a market order. The market order will not be sent to the exchange until the price is crossed. Second, the stop limit order. To place this type of order, you must put in an actual price that is the least you will accept to sell or the most amount you're willing to pay for a stock. Third is the trailing stop loss order. Trailing stops will put a stop at a specific amount below the current price. The stop loss rises as the price rises. For example, let's say that I bought a stock at $9.10 and I gave myself a 10-cent trailing stop loss. So let's say the price of the stock goes from $9.10 to $9.20. Well, my trailing stop loss will be raised from $9 to $9.10. The stock price goes from $9.20 to $9.30. My stop loss will be raised from $9.10 to $9.20. But now let's say the stock comes back, right? So again, if the price comes down to the last place that my trail was placed, right, which would have been at $9.20, I'm going to get stopped out. Trailing stop losses, they're great for automating your trades, right? So you don't have to sit and micromanage. So many new traders, they tend to shy away from using stops. This is bad. More advanced traders with discipline, they may use what they call mental stops. A mental stop is a price point you keep in your mind. When the price reaches, you manually submit your order, right? So you close your order out. You need great discipline to get out of a losing trade. This is not for new traders. A hard stop is when you send a stop order to your broker. So when that price is crossed, the order is sent automatically. So it takes it out of your hands, right? So let's say, for example, you're in a trade and all of a sudden your trade is down $100, right? So you're a little concerned. Maybe you're risking $200 in the trade, or you're thinking like, I'm willing to lose $200. But then it gets to 200 and you're like, oh, you know what? I just got this feeling it's going to reverse. And that's what a lot of new traders do, is they hope and pray that it's going to reverse back. Typically it never does. But again, they stand there with the idea that the stock is going to reverse back. And now all of a sudden your $200 loss turns into a $300 loss. Now you're getting even more anxious, right? You're getting freaked out. You're thinking, man, I've already lost $300. I can't afford to lose $300. You know what? If it gets back to 200, I'll sell it then and I'll just take $200 loss. Problem is, it goes from 300 to 400. Right? So if you put a hard stop in, you're taking the responsibility, you're taking the ability for you to stay in a losing trade out of your hand. Your new traders, they're going to freeze. They're going to hold on to the losing trade. They're going to hope it's going to rebound so they can break even. It doesn't. Use of a stop loss is vital to good risk management. So let's talk about order routing methods. The stock market is basically an auction house. Buyers and sellers, they go to this auction looking to buy or sell shares of a company stock. But to get to this auction house, all the buyers and sellers, they took different roads or routes to get there. When you submit an order, your broker determines the fastest route to connect the buyer and the seller to the exchange. This is called smart routing. You could choose a different route using a different electronic communications network, or otherwise known as an ECN. These ECNs, they're going to charge you various fees for use of their roads. You actually pay this in addition to any commissions you would for your broker. But this helps get your trade to the exchange much quicker, and you actually have control. Now let's talk about what a bid and ask price is. Every stock has a bid and an ask price. The bid is just like it sounds. Buyers can place a bid for shares, and they have to wait for a seller to agree to sell them shares at that bid price. The ask price is a price sellers set for what they're willing to sell their shares for, and must wait for a buyer who comes along who's willing to pay for that price. As a buyer, we want to get shares for the lowest cost to us. As sellers, we want to sell for the most we can get it for. Hence, buy low, sell high. Sellers can always sell at the bid price, but they must realize the price they can get for their shares will be lower. So now let's turn our attention to level 1. Level 1 is the first step to the market. This is the bid and the ask price that you see. The bid below shows there are 1,500 shares available to buy at $4.22. The ask price, which is on the right side, shows there are 5,200 shares to sell at $4.25. The spread on the stock is 3 cents. If you wanted to buy these shares, you could purchase 1,500 at $4.22. If you wanted more than 1,500, you would have to purchase the others at $4.25. So now let's talk about level 2. Level 2 shows you the depth of the market. Not only does it show you the bid and ask price, it also shows you how many buyers and sellers are below the bid and the ask price. We can use level 2 to tell if there are big buyers or sellers close to the price action. Each color represents a different pricing tier. New color tells us that there is a new price. Under the bid section, we can see a buyer or a collection of buyers at $4.12 that want to buy 21,500 shares. Time in sales shows us each transaction that is completed for a particular stock. Red orders are orders that are completed on the bid price. Green orders are orders that are completed on the ask price. Yellow, sometimes white, gray on other platforms, they show orders that are completed within the spread of the bid and the ask. The time in sales, they show us how orders flow. Lots of consecutive red means sellers are selling. Green means demand is up and buyers want in. So let's talk about float. It is important to understand that we trade within a closed market. We buy and sell shares to other buyers and sellers. When a company had this initial public offering, right, which is also known as an IPO, they put a fixed number of shares on the open market. The float or the float size is the number of shares that are available to trade publicly. Traders all trade from the same pool of shares. Large orders can be purchased by institutions and banks, which then take these shares and make them unavailable for trading. For example, say an institution or a hedge fund came in and purchased 60% of a company's stock. The number of shares that can be publicly traded on a daily basis is roughly 40%. So if this company had 1 million shares, its float size would be 400,000, which would be 40% of 1 million shares. Higher float stocks tend to move more slowly. As momentum traders, we're looking for stocks with lower floats under 100 million because they tend to be more volatile, right? They move more. If there are a limited number of shares available, the stock can move very, very quickly, especially if news breaks out. The law of supply and demand apply here. Low flow stocks tend to have a wider price spread, so be mindful when trading them. So let's talk about the order entry window. The order entry window is where you place your orders to either buy or sell. In your trading platform, you would enter the number of shares you wish to purchase, enter your preferred bid price, and submit your order to the exchange. Some software will let you double click on the ask or bid price to make selecting your input price quicker and easier. Longing versus shorting. Longing a stock is when we purchase a stock because we believe its price value will increase. We purchase using a market or limit order, and we hope to sell for more than we paid for it using a market or limit order to sell it. This is called being bullish on a stock. We think the value will increase. Shorting a stock is done when we believe the price is going down and the price is overvalued. The process of shorting a stock is done by borrowing shares from your broker or, quote, selling shares we do not currently have and later buying those shares back to return to the broker. This is also known as covering. So let's talk about short selling. A short side trade are traders who short a stock. They're borrowing or selling shares that creates a negative share balance in their positions. So for example, if you shorted 1,000 shares of a particular stock, in your positions in your trading software, it will reflect a negative 1,000, which means you're shorting. To close out that trade, the trader has to buy the shares back so they can return them to the broker, right? So when we talk about borrowing, you must borrow shares from your broker in order to short. If your broker doesn't have the shares to lend out, you will not be able to short that stock. You will never be able to short IPO stocks because brokers almost never have them to lend out. So when we talk about covering, to close a position, you must, quote, cover your position by purchasing the same amount of shares you borrowed from your broker. So in the previous example, when we shorted 1,000 shares, we must purchase 1,000 shares to give them back to the broker. So let's talk about days to cover. Most brokers, they'll give traders who borrow shares a certain number of days to cover. This varies from broker to broker. On average, I've seen 7 to 14 days, some even longer. If you fail to cover in the required time frames, the broker can do it for you manually and most likely hit you with a massive liquidation fee. Short interest refers to the number of shares all traders currently hold as a short position on the stock. If the outstanding shares or the float is 10 million shares and 2 million shares are short, the short interest on the stock is 20%. When stocks have a short interest of 30% or higher, there is a potential for a short squeeze. So a short squeeze occurs when buyers see value in a stock that is heavily shorted. They see the stock price as undervalued. As buyers pile in, the price increases. As the price increases, these short sellers, they quickly try to buy back their shares, which also helps drive the price even higher. This buy-sell imbalance can lead to stocks making 50 to 100% moves intraday, right? So that's day trading. So let's talk about the difference between day trading versus swing trading. It all starts with the big picture, your daily chart. No matter what style of trading you do, it will always start with your daily chart. Day trading is opening a position and closing the position within the same trading day. Any positions open in the pre-market, regular hours, or after hours and close before 8 p.m. on the same day is considered a day trade. Swing trading is the opening of a position and holding the position overnight for 2 days or more, but generally not more than 15 trading days. Anything longer and you become an investor. So no matter what style you choose, it always begins with the daily chart. The daily chart tells us the overall momentum of a stock. The daily chart consists of moving averages which tell us the trend of a stock. the volume of a stock, and whether the stock is overbought or oversold. As day traders, we get our ideas from the daily chart. The daily chart will tell us how we should play a stock to either the long or the short side. If a stock is trending up, we're going to long the stock and we're going to sell it for a profit. If the stock is trending down, we're going to short the stock and we're going to cover for a profit. If the stock is trendless, which means it's going sideways, we're going to do nothing and we're going to wait for a trend to emerge. So for example of this here, we see the daily and intraday chart for AAPL, which is for Apple. On the left-hand side, by using the daily chart, right? Again, like I said, it's the big picture, right? It's the Bible. It tells you how to play a stock. If a stock is in an uptrend, right? The stock is going up. It keeps making higher prices. The last thing we want to do is be counter trend traders, right? We're trend traders. We trade in the direction of the overall trend. And if you look on the left side, you can see that the stock keeps getting higher and higher. So the trend is up. So we can relatively say that if we're going to take a trade intraday, right, or a day trade of this Apple stock, then we need to be looking for the long, unless there's something on the daily that tells us that the stock is going to reverse its trend. But nothing on the left side tells us anything's going to be different than the days before. So you can see on the right side, the stock kind of got down to about 309.75. And again, you'll learn all these rules and patterns and stuff later on, but the stock got down to 309.75 and then made it up to like almost, 312.50. So it's almost a $3 rip there. But if you had gone into this saying, well, I'm going to short this stock today, what would you have done? The stock would have gone from like 311 down to 309 and then went up to 312. So you would have lost $1 per share, all because you thought you were smarter than the market and I'm going to short the stock today. So again, the daily chart tells us how we should be playing a stock, or how we should think about playing a stock, whether we should be longing it or shorting it. If the trend is up, we're going to long it. If the trend is down, we're going to short it. So let's talk about technical analysis. Technical analysis takes market data such as price history and moving averages, and it's going to provide us the basis for each of our trades. Technical analysis of stocks and trends is the study of historical market data, price, and volume. Using both behavioral economics and quantitative analysis, technical analysts aim to use past performance to predict market behavior. Price movement of a stock is determined by the law of supply and demand. When demand for a stock is higher than the amount of shares available, the price is going to go up because buyers have to pay more for those shares. When the supply of the stock is higher than the demand of a stock, the price is going to go down because sellers are forced to lower their asking price to sell their shares. So let's talk about charting, right? Let's talk about price. Charting gives us the visual representation to see the actions of other traders. Two of the most important components of charting is price and volume. Price is the most important component and feature of every single chart. Price is shown on a chart by candlesticks. Price also shows the trend of a stock. Price also shows us how a stock reacts around key levels on a chart. Price also shows us a pattern of a stock or a setup. So let's talk about volume. Volume shows us the number of shares that were traded in a specific period of time. Volume also shows us the liquidity of a stock. Can I get in and out of a trade pretty easily? It also shows us the relative volume compared to its average volume days. It also shows us accumulation and distribution patterns. So let's talk about what accumulation and distribution is. Accumulation is when buyers are in control. Institutions and investors, they're buying up shares. They see value in a stock, so they buy it, right? They're accumulating. Distribution is when sellers are in control. Institutions and investors, they're selling or they're dumping their shares. So now to the all-important question, what charting software should I use? Listen, there's a lot of different charting softwares out there. Typically, most of you will use the charting software that comes from your broker. So if you go through like TD Ameritrade, you'll probably use Thinkorswim. If you go through E-Trade, you'll probably end up using yours. If you go through Fidelity, they have their own. There's other places like TC2000 that not only offer you really, really robust charting software, but they also offer you the ability to trade through their brokerage firm as well. So again, the charting software you have to choose from is the one that's offered through your broker. Like I said before, usually most of the broker's charting software, their capabilities, they suck. Really, my biggest complaint when it comes to scanning or the ease of use, the ease of the order entry process. There is software like TC2000 They actually have free and paid versions. Trust me, when you get the free version, you're getting exactly what you pay for. It's almost impossible to really start trying to really trade. It's nice to get comfortable with, but if you actually want some functionality, you're going to have to pay something for it. There's a website called finviz.com. They also have free and paid versions. There's another website called TradingView. They have free and paid versions. Actually, you can do a lot more with the free version than you can with most of the other free stuff. But again, it's nice. Market Chameleon, they also offer paid and some sort of like limited access to certain things. And of course, there's Thinkorswim, which the software is totally free. You just have to have a brokerage account with TD Ameritrade. So again, you'll have a lot of different options. But the one thing you need to remember in selecting your software is you're going to be staring at the software nearly every day that you trade. So this may, if you're trading for the next 10, 20, 30 years, you're going to be looking at this software every day. So if you need something that's aesthetically pleasing to you, then maybe you might want to select something that's a little bit more visually appealing. If ease of use is more important to you, being able to get your trades in and out quick, if that's important to you, then you need to select something on that. But you need to make sure that whatever you pick, this is the one that you're comfortable with, and it offers all the features that you need so you can decide which trades to take. The moving averages, they serve two purposes, right? First off, they identify the trend of a stock. They identify the areas of support and resistance. The daily chart moving averages and indicators that I use is price, volume, the 9 EMA, the 20 SMA, the 50 SMA, the 200 SMA, the Bollinger Bands, the stochastics, and the ATR, which stands for average true range. So let me explain what these moving averages and indicators mean. So price, obviously, it's the current price of a particular stock. Volume is the number of shares of a particular stock that is bought and sold. The 9 EMA stands for 9 exponential moving average. It places more emphasis on recent data points. The 20 SMA is the 20 simple moving average. It's calculated using the average of the previous 20 candles. Regardless of what chart you're using, it's the previous 20 candles because the 20. The 50 SMA is the 50 simple moving average. This is calculated using the average of the previous 50 candles. The 200 SMA, it stands for the 200 simple moving average, calculated using the average of the previous 200 candles. Now, when I look at my chart, the 9 EMA, it gives me the most recent data points. It gives me the most recent trend of the stock. The 20 SMA, again, it's still fairly recent, right? So this is more of a short-term trend, right? It's a short-term average. So it tells me what the short-term trend of a stock is. The 50 is a little bit more of an average trend, right? So it gives me something average over 50 days or a 50 candle period, right? So technically the candles on your daily chart, they're going to be daily charts, right? So it's going to be 50 candles. So over the last 50 days, the last 50 trading days, that price will be, or the plot on your chart will be the average price over the last 50 trading days. And of course, the 200 gives us the long-term trend of a stock. So let's talk about Bollinger Bands. Bollinger Bands is a technical analysis tool to generate oversold or overbought signals, and it was developed by John Bollinger. So typically it composes of 3 lines, the upper, the middle, and the lower band. I only use the upper and lower band. So think of the Bollinger Band as the normal path that a stock travels, right? It travels between the upper and the lower bands. So the upper and lower bands are typically 2 standard deviations plus or minus from a 20-day simple moving average, and it can be modified. When the price continually touches or breaks above the upper Bollinger Band, it can indicate an overbought signal, which means many traders have bought the stock. So a lot of short sellers will see this and think the stock is overvalued, we're going to short it. And then some people will try to sell because they want to take their profits. If the price continually touches or breaks below the lower band, it can indicate an oversold signal, which means all the shares have been sold, right? So traders come in, they say, hey, we think the stock is undervalued. We think the stock's going to go back up. And they'll actually come in and they'll buy the oversold stock. So often when the bands are broken through, the price will travel back inside the band, right? Like I said, it's like a rubber band. Like you can only stretch it so far, but then it has to kind of snap back. So again, we want to think of the Bollinger Band as a rubber band, which kind of really keeps the stock price confined. Like it has some give, right? It will expand, but typically it will snap it right back in there in between. So let's talk about stochastics. Stochastics are a favored technical indicator because they're easy to understand and have a relatively high degree of accuracy. The indicator provides buy and sell signals for traders to enter or exit positions based on momentum. Stochastics are used to show when a stock has moved into an overbought or oversold position, right? So typically, I'll use this in coordination with my Bollinger Band. It's beneficial to use stochastics in conjunction with other tools like the Relative Strength Index, the RSI, to confirm a signal. So when a stock is above 80, it means the stock is overbought. If it's above 90, it's extremely overbought, right? So typically, and there I'll teach you a pattern later on that will show you how you can actually benefit from a stock that is severely overbought. Below 20 means the stock is oversold, right? Below 10 means it's extremely oversold, and there's a very good chance that within the next couple of days of that stock that it's going to snap back up into the Bollinger Band and of course back above the 20. We're to the last part of this lesson, journaling your trades. It's vital as you begin your trading journey that you start tracking every trade you take, whether it's a simulated trade or a live trade. It's not enough to rely on your trading platform to keep a running log of the trades you've taken in the past. Your trade journal should include the ticker, the price pattern, the time of day that you took the trade, whether you longed or shorted it, the position size you took, your entry price, your exit price, your stop loss, your profit loss for the trade. This will serve as a baseline when you begin your trading career. As you get more experience, you can look back over your trades quickly and you're going to be able to identify which price patterns that you're trading successfully and that are profitable for you and the ones that you're not. And you can adjust your trading strategy accordingly. I actually have an Excel spreadsheet that you can download for a trade journal from the download section of this class. Again, use it, track everything. So again, you're going to learn so many patterns and you're going to try different patterns and you're going to see, you can just look and see what the profit and loss is, and you can actually look and see, well, I trade a bull flag better than I do a base breakout. So again, as you go and you look back over the trades you've taken, you'll be able to quickly see what patterns are your most profitable so you can focus on what you're good at, and the ones that you're not so good at, stay away from them. Right? It didn't work. I mean, if it doesn't work for you, it doesn't work for you. But if you find one or two patterns that you are just a master of, that's all you need. It's all you need. So that's it, folks. We've just wrapped up the first of our 4 free comprehensive tutorials here that I hope has given you a taste of what it's like to navigate the exciting world of stock trading. If you found today's content insightful, first, give it a thumbs up. And if you're eager to dive deeper into this rewarding field, I have an incredible opportunity for you. Just below this video, in the description box, you'll find a link to my bootcamp course at parabolictradingbootcamp.com. Clicking that link will unlock an unprecedented opportunity for you to master trading patterns that have proven their worth time and time again. And here's the kicker. I'm offering to you this at a launch price of $97. That's over 60% off the regular price. I believe in empowering my students to succeed, not in perpetual subscriptions. So when you join my bootcamp, you get lifetime access with no ongoing subscription price. Now, you might wonder, how am I different from other trading educators? Well, unlike some of them who use their course fees to trade and profit for themselves, my main goal is to help you become independent and profitable in your trading journey. They need your money. I do not. I am a successful trader with or without your money. My goal is to share the knowledge and experience I have gained over the years in becoming a profitable trader and help others find their financial independence. Unlike other trading educators, I teach you how to trade the market up and down, whereas others, they teach you one or two patterns to the long side, which is great if the market is strong and it's always going up. But that's not how the market works. You have to know how to play the market to the downside if you want to make money regardless of how the market is going. My focus is on providing you with valuable tips, insights, and real-world techniques, not just filling my own pocket. That's the Parabolic Trading Bootcamp commitment. So why wait? Start your journey to becoming a successful stock trader today. Remember, this offer isn't going to last forever. Make some extra money, take a vacation, supplement your income from your full-time job, pay your kids' college, learn to become profitable enough to quit your day job and trade the stock market for an hour or two each day, and spend the rest of the day with those that you care the most about. My friends, I want to share something with you that I believe truly sets the Parabolic Trading Bootcamp apart from anything else out there. I'm introducing a double money back guarantee. That's right, you heard it correctly, double your money back. Go ask other trading educators if they're willing to offer you the same deal. Some of them are too busy paying $3 million FTC fines for misleading their students. Others are focused on having you spend thousands of dollars for live boot camp classes that are routinely canceled and take 2 months or more to complete. These same trainers then force you to pay $199 a month to join their chat rooms where they tell you what trades they are taking only to sell you the shares they are trying to unload themselves. This is how strongly I believe in the effectiveness of the proven trading patterns and rules I'm going to teach you at the Parabolic Trading Bootcamp. So here's the deal. If after 6 months of faithfully following our trading patterns and adhering to our rules, you haven't managed to double the cost of this course and profits, I will personally give you back twice the money you spent on this course. This is how much I believe in what I'm teaching you, and I'm willing to put my own money behind it. Are they? But here's the catch. This offer only applies to those students who have diligently studied the material, abided by the training rules, and reached out for advice and guidance when needed. If you ignore my teachings, dismiss the patterns and the rules associated, and you let your emotions drive your trades, you will not qualify for the refund guarantee. I'm here to help change your financial life, but you need to meet me halfway. You need to commit, learn, and adapt. I believe in you and your potential to succeed in training. Now it's your turn to take the leap of faith and join us at Parabolic Trading Bootcamp. So I'm offering a package that is absolutely packed with value. Here's exactly what you're going to get when you join me at Parabolic Trading Bootcamp. First, you're going to get over 18 hours of recorded video content updated with new examples weekly. That's a $19.97 value right there. Second, I'm going to provide you with over 20 proven profitable trading patterns to help you take charge of the market. 3, I'm going to give you examples to show you how these patterns are played in real time. On top of that, I have swing trading strategies that can help you earn while you're working your day job. And for those ready to take the plunge, I'm going to offer you day trading strategies to help you quit that day job and focus on trading full time. You're also going to have access to recorded live trades where you can learn directly from how I played a trade. You're also going to have access to periodic live bootcamp classes where you'll also have access to recorded bootcamp classes. I'm going to give you access to my personal TC2000 layouts and scans, as well as access to my Thinkorswim layouts and the scans. And most important, you're going to get the chance to quit your day job and achieve financial independence. That, my friends, is truly priceless. But that's not all. You're going to also gain access to our future courses on cryptocurrency, options, and Forex as they're released. But be warned, once these are out, the price of the program is going to go up. Now, you get all of this, a package worth thousands of dollars for the limited time launch price of just $97. That's more than 67% off the normal price of $297. $97 can change the rest of your life. I have students who paid thousands to learn from me, and it's changed their financial lives. It doesn't matter if you've been at the same job for 10 years, if you're a single mother, if you're a freshman in college. Taking control of your ability to read and play the stock market will bring you more success than just about any job out there. And you won't be limited by salary or hourly wages. You won't be subjected to layoffs or downsizing. You will truly be in control of your financial destiny. $97 is what it costs for a typical date in a movie. Then it's gone. Take the same $97, invest in yourself, and turn your reward to risk ratio into numbers you could only dream of. Do not hesitate. Enroll today and embark on your journey to financial independence with Parabolic Trading Bootcamp.